For a long time, Arizona looked like the clean version of the American dream. Open space, big skies, new suburbs, a fast growing economy, a lifestyle that felt calmer than California, cheaper than the coasts, and easier than the big city grind. You could buy a house with a yard, drive 10 minutes and see mountains, and still feel like you were part of something expanding. But heading into 2026, that story is breaking down. And it's not breaking down for one reason. It's breaking down because multiple pressures are hitting Arizona at the same time, in the same direction, and the market can't absorb it anymore. Mortgage rates stayed higher for longer, which crushed purchasing power. Affordability fell off a cliff, even for households that used to qualify easily. Insurance and ownership costs have quietly risen in places people never expected. Builders delivered a wave of new inventory based on yesterday's demand. Investors and short-term rental owners who fueled the last run-up are pulling back, and the migration narrative that carried this state from 2020 to 2023 isn't as reliable anymore. That combination is how hot market turns into correction. Not with one dramatic crash headline, but with months of stale listings, price cuts that don't move the property, new builds offering incentives that still can't bring buyers off the sidelines, and homeowners discovering that the monthly cost of owning is nothing like what they imagined when they bought. This is across US 4. And today, we're counting down 10 Arizona cities where home prices are most vulnerable to a serious drop in 2026, places where the math is already getting shaky, and the next leg down is no longer just possible, it's becoming likely. And stay with me until number one. Because the city at the center of this downturn isn't the one most people expect. It's the one that tells you what happens when growth runs faster than reality. Before we get into the list, I need you to understand the four forces driving this entire shift. Because if you get the forces, you'll recognize the pattern anywhere. Arizona, Nevada, parts of Texas, segments of Florida, even pockets of the Carolinas. The four pressure points breaking Arizona's housing story. Pressure point number one, payment shock. A home isn't bought with a sale price. It's bought with a monthly payment. And when rates rise, payments explode, even if the price barely moves. That's why markets can go from bidding wars to silence without a recession headline. If the same house costs hundreds or thousands more per month to finance, your buyer pool collapses. Pressure. Point number two, ownership costs that don't show up in the listing price: insurance, property taxes, HOAs, utilities, maintenance, and special assessments. These don't trend on social media, but they're the hidden taxes that kill affordability in real life. Arizona is dealing with rising premiums in many areas tied to wildfire exposure, extreme heat, storm events, and replacement costs. And on top of that, utility costs and repair costs climbed. Pressure point on number three, inventory and builder overreach. A lot of new construction was approved and started when demand looked endless. Those projects don't stop quickly. They deliver into a market that is already cooled. And when builders have too much inventory, they don't just cut prices. They create a new price reality through incentives, closing costs, rate buydowns, upgrades, price drops. That hurts resale values because homeowners can't compete with a builder who can subsidize financing. Pressure point number four, investor retreat and the short-term rental reset. A meaningful slice of the boom was driven by investors, especially in lifestyle and vacation markets. When occupancy drops, regulations tighten, or financing costs rise, those assets turn into liabilities fast. And investors don't hang around emotionally. They exit quickly, often all at once. With that framework, let's get into the countdown. Number 10, Prescott sold itself as the perfect escape. Cooler weather, pine-covered hills, a charming downtown, and a slower rhythm that felt like the opposite of Phoenix sprawl. It became a magnet for retirees and out-of-state buyers who wanted Arizona without the brutal heat and congestion. And during the boom years, that demand got exaggerated into something dangerous. Prices ran up faster than local incomes could ever support. Here's the problem heading into 2026. The buyer base that propped Prescott up is more sensitive to rising costs than people realize. Retirees on fixed incomes don't have the flexibility to absorb rising insurance, rising maintenance, rising HOA fees, and rising property taxes. They live on budgets, and those budgets have ceilings. When monthly ownership costs creep up, it doesn't matter how pretty the neighborhood looks. People start selling. On top of that, Prescott's last surge pulled forward years of demand. A lot of buyers who would have bought in 2025 or 2026 already bought in 2021 and 2022. That leaves a vacuum. And then you add the new supply angle, Prescott Valley, and surrounding areas saw aggressive development pitches, retirement ready, new builds, easy living. But new builds only work if demand stays hot. When demand slows, that inventory becomes a weight. You start seeing rows of listings that look almost identical, all competing for the same shrinking pool of qualified buyers. So Prescott's weakness is simple. It's a lifestyle market that got priced like a luxury market. And now the people who were supposed to carry it can't justify the cost. Number 9, Gilbert has been the safe bet suburb for a long time. Clean, planned, family-oriented, and seen as a stable place to park your money. But the same thing that made Gilbert feel untouchable is what makes it vulnerable now. It became a symbol of suburban perfection, and suburban perfection got overpriced. During the pandemic surge, Gilbert absorbed huge demand from relocation buyers, and it wasn't just population growth. It was perception. People believed Gilbert couldn't lose because it always wins. That belief is dangerous in real estate because belief is how buyers overpay. Heading into 2026, Gilbert is dealing with a classic high-end suburb problem. The monthly payment for the median home has moved into territory where even six-figure households feel squeezed. And once a market starts relying on high-income buyers to keep prices afloat, it becomes sensitive to any slowdown in hiring, any tightening in lending, any pullback in confidence. Then there's the investor angle. Suburbs like Gilbert saw short-term rental and long-term rental investors pile in, especially when rents were climbing. But if rent growth slows while taxes, insurance, and financing costs rise, the returns get crushed. And when returns get crushed, investors become sellers. Gilbert won't implode overnight, but it doesn't need to. A slow grind down, month after month of stale listings and price cuts is enough to reset the market. Number 8, Flagstaff. Flagstaff has always been a special case. It's a mountain town, a university town, and a tourism town. For years, people treated it like it was insulated from everything else. But insulation is not immunity. Flagstaff's biggest vulnerability heading into 2026 is affordability. A lot of buyers want Flagstaff. Not many can buy Flagstaff at current payments. A high-priced market can survive if there's a constant inflow of wealthy second home buyers. But second home demand is the first thing to soften when borrowing costs stay high and the economy feels uncertain. People delay the cabin purchase. They delay the lifestyle upgrade. Then you add the short-term rental reset. Flagstaff is exactly the kind of market where investors thought they had. A printing press, rented to tourists, fill the calendar, collect the premium. That works until tourism softens, regulations tighten, or operating costs rise. Then suddenly, your asset is a monthly bill with unpredictable income. When enough owners reach that point, they all list at the same time. And the market doesn't care how beautiful the pines are. Supply is supply. Flagstaff's correction is what happens when a desirable place becomes financially unreachable for the locals and less attractive for the outsiders. Number 7, Tucson was supposed to be the reasonable Arizona market. More affordable, more laid back, and more grounded than Phoenix. But Tucson got pulled into the same boom psychology. Prices rose faster than wages, and that gap doesn't close politely. Tucson's pressure point heading into 2026 is that the ownership cost stack is getting too tall for the median household income. Even if prices soften, the monthly carry still hurts because taxes, insurance, and utilities don't politely retreat at the same pace. Tucson also has a risk factor that buyers increasingly price in: weather volatility, flooding patterns, monsoon damage, wildfire risk in surrounding areas. These issues don't just stay in the news. They show up in insurance quotes, in repair costs, and in buyer hesitation. And you can feel the market psychology shifting when active listings rise and buyers stop rushing. Tucson was built on being a value market. When the value disappears, demand dries up quickly. Number 6, Mesa. Mesa is one of the clearest examples of what happens when expansion becomes a trap. During the boom, the East Valley saw massive building, master-planned communities, new subdivisions, new phases rolling out like a conveyor belt. That works when migration is hot and financing is cheap. But heading into 2026, Mesa is facing what I call the overhang problem. Too many homes delivered into a market where the buyer pool is weaker. And here's what makes Mesa especially vulnerable. Builders can undercut resales. If you're a homeowner trying to sell, you're competing against a builder offering rate buydowns, closing cost coverage, upgrades, and incentives. That forces resale sellers into price cuts just to stay relevant. Then add rising ownership costs. A lot of homeowners can tolerate a mortgage. They can't tolerate a mortgage plus climbing insurance plus HOA, increases plus repairs in an era where labor and materials cost more. Mesa's correction isn't just about the numbers. It's also about confidence. When a market was built on the assumption homes always go up, the moment prices go down, sellers panic, buyers freeze, and the correction feeds itself. Number 5, Sedona. Sedona is what happens when beauty gets financialized. For years, people treated Sedona as a spiritual retreat, an artist town, a desert sanctuary. Then it became a portfolio asset. Second homes, vacation rentals, luxury appreciation plays. That shift matters because asset buyers exit faster than lifestyle buyers. Sedona, heading into 2026, is dealing with a pressure stack, high prices, high operating costs, and a less reliable short-term rental story than investors assumed. When occupancy drops, when tourism demand softens, when regulations tighten, when insurance and maintenance rise, those stunning homes become expensive liabilities. And when investors list, they flood a market that is already narrow because the buyer pool is limited. Sedona can still be Sedona and still drop hard in a correction. Those two things can be true at the same time. Natural beauty doesn't pay the mortgage. Number 4, Scottsdale. Scottsdale has always been a signal market. It's where money goes when money wants lifestyle. But luxury markets are not immune to gravity. In fact, luxury markets can fall harder because their buyer base is more discretionary. Scottsdale heading into 2026 is vulnerable because the cost of ownership is becoming outrageous in certain tiers. Insurance, HOA assessments, property taxes, maintenance, and the general carry cost of luxury living. When those costs rise, buyers become picky. Cash buyers don't rush. They negotiate. They wait. And if sellers are anchored to peak prices, listings sit. Then the psychology flips. A home sitting for 120 days becomes a question mark. A home sitting for 200 days becomes a signal that the market is broken. Scottsdale's vulnerability isn't that it will become cheap. It's that it can reset sharply because its pricing depends on confidence, liquidity, and desire. Three things that change fast. Number 3, Chandler. Chandler built its identity around high-skilled jobs, tech expansion, and the image of modern prosperity. That narrative helped push home prices up because people believed the job engine would keep demand endless. But housing markets that lean on high-paying sectors are sensitive to corporate behavior. Hiring slows, projects pause, remote work shifts, budgets get trimmed, and suddenly you have a market priced for perfect conditions in a world that no longer offers perfect conditions. Heading into 2026, Chandler's risks include overbuilding in certain pockets, buyer hesitation due to payment shock, and a shrinking pool of people willing to pay top dollar when the job market feels less certain than it did during the boom. Chandler's story is a reminder. A strong economy doesn't guarantee a strong housing market if affordability collapses. Number 2, Phoenix is the engine, and engines overheat. Between 2019 and 2022, Phoenix became a national obsession. Prices surged. Bidding wars were constant. Out-of-state money poured in. Builders expanded aggressively. Investors treated the city like a guaranteed appreciation machine. But markets don't stay extreme forever. Phoenix, heading into 2026, is dealing with a long unwind. Higher inventory, slower migration, weaker investor appetite, and buyers who can no longer rationalize the monthly cost. And the suburbs around Phoenix matter here. When you see large amounts of unsold inventory on the outskirts and builders offering incentives, it drags on the entire metro. Because the marginal buyer doesn't care about city boundaries, they care about a payment. Phoenix doesn't need a dramatic crash to hurt people. A multi-year grind lower can erase the wealth created during the boom just as effectively. Number 1, Buckeye. Buckeye is the clearest warning sign because Buckeye represents the most aggressive form of the Arizona dream. Endless new suburbs pushing outward, master-planned communities promising schools, parks, retail, and a future that always expands. But Buckeye's problem is the one that destroys boomtowns everywhere. Supply got ahead of reality. Developers built as if demand would remain permanent, as if people would always keep moving further out, as if affordability would stay intact, as if financing would remain easy, as if infrastructure would keep pace. When those assumptions fail, the model collapses fast. Buckeye, heading into 2026, is vulnerable because it's the kind of market where buyers become extremely sensitive to any friction. Long commutes, unfinished infrastructure, delayed amenities, water concerns, rising insurance, rising utilities, rising taxes, rising rates. And here's the brutal part. In outer ring boomtowns, once price momentum reverses, buyers start waiting. Nobody wants to be the person catching the falling knife. That freezes demand. And when demand freezes in a place with heavy new supply, The only way to move product is price cuts and incentives, big ones. Buckeye is what happens when optimism becomes denial and construction becomes a bet that the future will behave like the past, and it doesn't. What this means for buyers, sellers, and investors in 2026. Now let's end this the right way, because a downturn isn't just doom, it's information. If you're a buyer, the lesson is simple. Stop shopping for the prettiest listing and start shopping for the strongest math. Look at the monthly carry, not the sale price. Insurance, taxes, HOAs, utilities, commute costs. These are the real affordability killers. If you're a seller, understand this. The market doesn't care what you paid. It cares what a buyer can afford today. If you're competing with a builder, you may be competing against incentives you can't match. Price accordingly, or prepare to sit. If you're an investor, you need to face reality. 2020 rules are gone. Cheap money is gone. Easy appreciation is gone. If the deal doesn't cash flow with conservative assumptions, it isn't a deal, it's a gamble. From Prescott's retirement story losing altitude, to Flagstaff's second home market getting hit by affordability, to Phoenix unwinding a historic boom, to Buckeye showing what overbuilding looks like in real time, Arizona is entering a reset, not a headline, a reset. And the men who win in resets are the ones who stay calm, stay patient, and stop believing stories. They follow numbers. You've been watching Across US 4. If you want more deep, data-minded breakdowns of where the housing market is cracking next and where real opportunity will appear as sellers get desperate, subscribe now. Because 2026 isn't just a year. It's the year the desert dream gets tested by reality.